Good morning, everyone. I'm back to talk to you about Chapter 7 today. Chapter 7 today is about accounts receivable and notes receivable. And what we're going to talk about today are adjustments that you are going to make as managers in any organization that has accounts or notes receivable. So what happens is there is a certain amount of, that accounts receivable is money that other people owes our company. And we all know that there is a certain amount of debt that doesn't get paid. Whether it's a 5% or 10% or 1%, it's going to depend on the industry. But what can happen is if your accounts receivable, let's just say, are $1 million and 5% of the people that owe you money are not going to pay, then your balance sheet is off by $50,000 because your accounts receivable are $1,050,000 aren't going to get paid. So your current assets are off by $50,000 as an estimate. So there has to be a way that a company tracks what amount of accounts receivable they're not going to receive. So that's what we're going to talk about in this chapter. And at the very end, we're going to talk about calculating interest for notes receivable. If we start out and we're talking about a company that buys credit, they buy their product on credit from you. During this whole chapter, we are going to be the owner of the accounts receivable. We are the company doing business. So this says on July 1st, TechCom had a credit sale of $950 to CompStore and a collection of $720 from RDA Electronics from a prior credit sale. So you know how to do journal entries for accounts receivable. July 1st, accounts receivable, CompStore, sales for $950. Also, on July 1st, we received payment from RDA Electronics. So we have a debit of cash and a credit of accounts receivable. That's pretty simple. Both of those companies had a certain amount of debt they owed you, and both of them paid. So when we're talking about sales on credit, we need to understand that not only do you have that T account or that ledger for accounts receivable, you have a separate T account for each company. So if we talk about accounts receivable, back to that wonderful squeak. You guys all know that accounts receivable is a current asset, and then we have 4 different companies that owe us money. We have, I'm going to use my family names, KO, and this account owes, I'm going to say I owe your company $100. Oh, it's an accounts receivable for you, so it is a debit, not a credit. And RO is a separate customer, and they owe you $100. And Natalie Broekhoven also owes you $100, and Caitlin Music owes you $100. These are all separate accounts. These are all separate customers, and your total up here for your accounts receivable is $400. So when someone pays you, you're going to debit cash, credit accounts receivable, but you're also going to keep track in the individual customer's account. Those of you who work in a bank know that every customer expects to have their separate account, and the same is true for accounts receivable or accounts payable. Every person, every company has their own account so that you know that when it's paid in full or when they borrow or owe more money to you. So keep them out, and we are only going to do the total accounts receivable here, but in any company, every debtor has their own ledger account that you keep track of and reduce when they pay or increase when they take on more debt. So sales on credit, accounts receivable, CompStore, sales, and then when they pay it, you give them a credit on their accounts payable or accounts receivable. And so if a company calls you and they call and say, oh, we owe your company $500, but we are not going to be able to pay it. And you just write that off directly, and you have a bad debt expense, and so you would debit bad debt expense for $500 and credit the accounts receivable for $500. And if you are a small company and you're on the cash basis, that's okay. That's called the direct write-off method. And if it's a very small amount, or like I said, you're a very small company, it's okay. But if you're an accrual basis company, or it's for a large amount, that may not be okay, because remember our matching principle, we have to match the expenses to the period in which we had sales. So if you sold this company something in October and they had a 30-day pay period, and by the end of the year they hadn't paid it, so you're into January or February of next year and you have a bad debt expense, then clearly that bad debt expense does not match when you made the sale. So then we have to use an allowance method, and an allowance method is where we go in at the end of the year and we make those adjustments, and we say from this past year, so let's say 2018, it's December 31st, and we say from 2018 we need to go back and make a determination of how many debts we are not going to get paid, how many of those are bad debts. So the difference in direct write-off method is it's a cash basis, it's small companies, it's when it's immaterial. Allowance method is how big companies do it, and so they match their expenses to the year in which the revenue occurred. We've already talked about the direct write-off method. You just debit bad debt expense, you credit accounts receivable, and you make sure that you make the proper entry in the customer's subsidiary ledger of accounts receivable, and then you don't loan them money anymore or let them buy stuff on credit anymore. So matching versus materiality, we know that's the whole reason between cash and accrual basis. So expense recognition principle requires expenses to be reported in the same accounting period as the sales they produce, and materiality constraint states that amount cannot be ignored if its effect on the financial statement, that an amount can be ignored if its effect on the financial statement is unimportant to users' business decisions. So matching and materiality, if it's a really small amount and it materially doesn't matter, then it's okay to do a direct write-off. But otherwise, we have to match those expenses to the period, the same accounting period as the sales they helped produce. Okay, here we go. So we know direct write-off method. You've got that one figured out. It's easy. Bad debt expense, accounts receivable credit, and it just writes it off. But at the end of each period with the allowance method, we estimate the total bad debt expected to be realized from that sales period. So we're going to look at history. We're going to look at how we know the people who buy from us. We know our customers, and we're going to make an estimate on how much we think our bad debts are going to be for this last year, for 2018. So there's two advantages to the allowance method. One is it records estimated bad debt expense in the period when the related sales are recorded. And two, it reports accounts receivable on the balance sheet at the estimated amount of cash to be collected. I already talked about the fact that if we're $1 million company, or we have $1 million out in debt to other people, and 50,000 of it we aren't going to receive, then our balance sheet is off by $50,000, and our expenses are off as well. So we have to make our best faith effort to make sure that the assets and liabilities on our balance sheet are correct, and our income and expenses on our income statement are correct. So there are three ways we can calculate the allowance method. Once again, we say, oh, accounting is black and white, but there's three ways it can be black and white. So we're going to go from the least accurate to the most accurate. So in this, again, we're going to have one of those contra accounts. You know this from depreciation. You know what contra accounts are. You know you have property, plant, and equipment, and then you have accumulated depreciation. That is a contra account. So we say we have $1 million in equipment and we have $50,000 in accumulated depreciation. Well, you know the book value of our equipment then. Well, in bad debt expense, we have accounts receivable and allowance for doubtful accounts. Accounts receivable is a current asset, and allowance for doubtful accounts is your contra account. So it takes away from accounts receivable. So we're going to start with what's called the balance sheet presentation. We have the current assets, we have accounts receivable, less allowance for doubtful accounts. Below is a balance sheet presentation that just shows accounts receivable net of $1,500 doubtful accounts. I prefer the top one. It's just good managerial skills to show as much as you can on your financial statements so that people have a good understanding. So just like we show equipment, less accumulated depreciation on our balance sheet, we're going to show accounts receivable, less allowance for doubtful accounts. It's just clearer that way and easier to understand for most people. All right, allowance method, writing off a bad debt. So TechCom has determined that J. Kent's $520 account is uncollectible. So this is the way we would make that journal entry. Allowance for doubtful accounts, debit, accounts receivable, $520. Now this is after we have made our contra account of allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset account, so it has a credit balance. So when we then determine that someone is not going to pay their debt from last year, what we would do then is debit allowance for doubtful accounts, credit accounts receivable, and we don't touch our accounts receivable major account, major ledger, because we've already accounted for this loss with an allowance for doubtful accounts. So I'm going to show you three methods. Bad debt expense, if we take the current period sales times bad debt expense, equal estimated bad debt. Well, that is a very broad way to estimate your your bad debt expense. Because some of those sales have already been paid, some of them were paid with cash. So although this is more accurate and moves the doubtful accounts into the right period, it isn't necessarily the most accurate way to compute bad debts. So this is what it looks like. If we do percent of sales method, we have $400,000 we estimate based on prior history or knowledge of our customers that we're not going to collect 6% of it. So our total allowance for doubtful accounts for Musicland is $2,400. So on December 31st, we make that adjustment. Bad debt expense, $2,400. Allowance for doubtful account, $2,400. This is considered an income statement method, and it is less accurate than when I'm going to talk to you about a balance sheet method, but more accurate than the direct write-off. The next one we're going to use is percent of receivables method. So you compute the estimate of the allowance for doubtful account based on year-end accounts receivable times bad debt percent. So bad debt expense is computed as total estimated bad debts expense minus the previous balance in allowance for doubtful accounts equals current bad debt expense. So here we go. Musicland has $50,000 in accounts receivable and a $200 credit balance in allowance for doubtful accounts on December 31st, 2017. Past experience suggests that 5% of receivables are uncollectible. Okay, so we know what our accounts receivable we have, and 5% of those are uncollectible. Now, if you notice on total sales, we said 6%. So you just have to use that managerial knowledge you have to decide on that, and historical information to decide on that percentage. So desired balance in the allowance for doubtful accounts is $2,500. 50,000 times 5%. So what happens is you take the unadjusted balance on the last day of the year. Here it's December 31st, 2017, and the unadjusted balance is $200. We know our desired balance is $2,500, so our December 31st adjustment is $2,300 because it brings our allowance for doubtful accounts up to $2,500. If we go back to percent of sales method, we just use the whole amount and add it to whatever the unadjusted balance is. But with percent of receivable method, we are adjusting to $2,500. So our bad debt expense is $2,300 and our allowance for doubtful accounts is $2,300. This is called a balance sheet approach, so it is more accurate than the income statement approach. And the last and final one is also a balance sheet approach, but it's aging of receivables. And then we classify our receivables by how long they are past due, and each age group is multiplied by an estimated bad debt percentage, and then estimate bad debts for each group are totaled, and then we make the same journal entries that we did for receivables method. So although this seems a little confusing at first, I'm going to explain it to you in depth so you understand it. So it's December 31st, and we look at all of our accounts receivables, and we age them. Some are not yet due. Some are just 1 to 30 days past due. Some are 31 to 60 days past due. Some are 61 to 90 days past due, and some are over 90 days past due. Now, the longer a debt becomes past due, the less likely it is to get paid, and less likely it is to get paid in full. So if you look at this chart, if it's current, they say, oh, we're probably not going to collect 2% of that. If it's 1 to 30 days past due, 5%, 31 to 60 days past due, 10%, 25%, and then on up to 40%. So that $900 that is over 90 days past due, there's not a high probability that we are going to be able to collect those funds. So you add all that aging up, and it totals $2,270. So we know that we want our allowance for doubtful account to have $2,270 in it. At this point, there is a $200 balance, so we would make a $2,070 adjustment to bring that account to where we need for it to be. So this is, I gave them to you in order of accuracy. Bad debt write-off is the least accurate because it may not even be in the right time period. And then we did percentage of sales, and that's not really accurate, but it actually moves the bad debt expense into the correct period. It's called the income statement approach, and you don't adjust on that for what is already in the allowance for doubtful accounts. You just add to what's an allowance for doubtful accounts. The next one is accounts receivable method, and that gets more accurate, and then you do adjust for what is in your allowance for doubtful accounts, and then we get to the aging of accounts receivable, which is the most accurate way to account for what is in your allowance for doubtful accounts. There can come a time when in the past you have overcalculated what your bad debt expense was, and in that case you would have a debit balance instead of a credit balance, and then you would have to overcompensate to get to the $2,270 that the aging of accounts receivable showed that you should have in the account. So here's a summary of the methods. We're bad debt estimations. We are not talking about direct write-off here. The one on the far left is your income statement focus, percent of sales, sales times rate equals bad debt expense, and your adjusting entry amount comes from percent of sales. If we go to the balance sheet focus, because then we're talking about percent of receivables and aging of receivables, the percent of receivables, accounts receivable times the rate equals allowance for doubtful account. So you start with your adjusted entry amount equals percent of aging, or percent of receivables, equals the minus the unadjusted credit balance, or the unadjusted debit balance that is already in your allowance for doubtful accounts. It's done the same way on aging and receivables, except then you actually have a chart that shows what your receivables are, how old they are, and you go by percentages there. So be ready to ask questions. This is going to move pretty quickly from here on out. So this is not that hard, but you do have to read the information, go through the PowerPoints, and do the homework assigned, and then I think you'll understand it with no problem. Notes receivable is the next thing. Notes receivable is usually in the industry. What happens when someone can't pay their accounts receivable, and they call you and they say, I can't pay in my 30 days, but if you can extend it for some time longer, I will pay you some interest. So a promissory note is a written promise to pay a specific amount of money, usually with interest, either on demand or at a stated future date. So that's what I'm going to teach you to calculate now. We've talked about interest before and how to calculate it, but you're going to be dealing with this your whole life when you're talking about cars, houses, promissory notes, money you owe your parents. You will always have to look at how to compute maturity and interest. So let's first talk about computing the maturity date. On July 10th, TechCom received a $1,000 90-day 12% promissory note as a result of a sale to Julia Brown. So Julia Brown owes you this money. It's $1,000 that's going to be paid with interest in 90 days. So let's first start by computing the maturity date. Well, 90 days is when it's due. So we're on July 10th, so we start out with the days in July. There's 31 days in July. So you need to learn some kind of an acronym. I say 30 days has September, April, June, and November. Everything else has 31 except February that has 28. So July is a 31-day month. We subtract the date of the note, which is the 10th. You never count the date of the note in interest, but you count the day the interest is paid. So 31 days in July minus 10. So days remaining in July are 21, days in August, 31, days in September, 30. So that's 61, 82 days so far. So we know we have 8 days left to the maturity date in October, 90 days. So we've accounted for when it's payable, October 8th, and then we have to calculate the interest. So in order to calculate interest, you take the principal times interest times time equals the interest amount. So a banker's rule is that every year has 360 days. We know that's not true. We know a year has 365 or 366 days if it's a leap year. But banker's rule in interest is 360 days. So if the note is for less than 1 year, then the interest rate is annualized. So here we're talking about 90 days. So it's $1,000 times 12% times 90 divided by 360, because this is only 90 days. So it equals $1,000 times 0.12 times 0.25 equals $30 in interest. Not only do you have to learn to calculate interest here, you need to memorize the interest computation. You will use that over and over again in other classes that you're doing. So that's it. Accounts receivable, notes receivable. Make sure that you've read that chapter 7. Make sure you're moving on getting the homework done. And if you have any questions, be sure to get in contact with me. Have a great day. I'll talk to you soon.